Picture this. You've finally retired after a lifetime of hard work, and now you're ready to start collecting those fat OAS checks from the government. These payments can max out at $9,481 each year right into your account. But that entire amount can be clawed back by the government if you aren't careful about it. Let me show you how that works. Here's an overview of the OAS clawback, otherwise known as the recovery tax. The OAS clawback kicks in when your income exceeds the threshold of $90,997 for the 2024 income year period. If your income reaches or exceeds $153,771, you will lose all of your OAS payments for that period. For the July to September 2024 period, the maximum monthly OAS payments are, for the ages of 65 to 74, it'll be $718.33 per month, which equals to $8,619 annually. For those age 75 and over, it's $790.16 per month, which equals to $9,481 annually. Here's an example. Meet David, a 75-year-old collecting OAS in Canada. In 2024, his income hits $160,000, which is well over the clawback threshold. Here's the bad news. Because of the OAS clawback, he'll lose all of his OAS benefits. Why? Well, the 15% recovery tax on the amount over the threshold, which is $90,997, adds up to $10,350. Since David's annual OAS benefit is below that at $9,481, he'll get nothing for that time period. Alright, now that you know you could potentially be saving over $9,000 a year, let's see some ways to reduce or avoid that clawback altogether. I'm going to go over 7 ways to avoid the OAS clawback, starting from the easiest to the hardest. The first strategy is to delay your CPP. One of the most effective strategies to reduce the OAS clawback is to delay your CPP payments until a later age, such as 68, 69, or 70. By doing this, not only do you increase your CPP payments by up to 42%, but you also lower your taxable income between the ages of 65 and 70, when the OAS clawback typically kicks in. For example, let's say you're eligible to receive $1,000 per month in CPP at age 65. If you delay till age 70, your monthly CPP payments would increase by 42%, bringing it up to $1,420 per month. Over time, this can make a big difference in your retirement income. Plus, because CPP is indexed to inflation, these higher payments will continue to grow in value for the rest of your life. For example, meet Peter Parker. Peter is experiencing a clawback of $8,111 at age 65 due to a high taxable income, because he is drawing both CPP and other sources of retirement income. However, by choosing to delay CPP, as you can see here, Peter's taxable income is reduced, resulting in a smaller OAS clawback of $5,844. This represents a savings of over $2,000 on the OAS clawback, just by delaying CPP. Not only does he save on the OAS clawback by delaying CPP, but he also secures higher CPP payments for the rest of his life, making it a win-win scenario. Now that brings us to our second easy strategy of defeating the OAS clawback, which is by delaying OAS. Another smart strategy is to consider delaying your OAS payments up to age 70. This increases your monthly OAS payments by 36%, which gives you more income later while reducing or even eliminating the clawback during the earlier years of retirement, when your income potentially could be higher. So for example, if you're receiving $500 per month in OAS at age 65, delaying until age 70 increases your monthly payments to $680, a 36% increase. This is a big boost to your retirement income, especially when combined with delaying your CPP. Going back to an example here of Peter, you see that he faces a clawback of $8,111 again at age 65. So that tells us that a significant portion of their OAS benefits is being reduced due to his high taxable income. This clawback occurs because their income exceeds the threshold, and he's also earning money during those years of 65 to 70 still. However, if you look here, you'll notice a significant difference. By delaying OAS until age 70, the entire clawback is eliminated. You can see here that the OAS clawback compared to before is completely gone. This happens because delaying his OAS when you know he has a higher income is a smart strategy. As a result, he avoids losing benefits and in turn receives a higher monthly OAS payment after the age of 70, which is an increase of 36% over 65. In short, delaying your CPP until age 70 can provide a dual benefit. Not only can you potentially avoid some or all of the clawback entirely, but you also get the advantage of higher payments later in life. Note that it's not always wise to delay CPP and OAS. For example, if you have health issues or a shorter life expectancy, delaying may not be the most beneficial option. Again, I want to stress that in Peter's specific scenario here, it makes a lot of sense for him to delay the OAS because of his higher income between the ages of 65 to 70. But that might not always be the case for you. So I want to stress the importance of planning specifically for yourself. The third way to reduce your OAS clawback is to use your TFSA wisely. A TFSA is one of the best tools to help avoid the OAS clawback because withdrawals from your TFSA are completely tax-free. This means you can access the funds for your living expenses without increasing your taxable income, helping you stay below the OAS clawback threshold. I'll go through an example to make this more clear. Imagine you have $100,000 saved in your TFSA. If you withdraw $20,000 per year to cover your living expenses, you won't owe any taxes on this amount and it won't be counted as taxable income. This strategy is particularly helpful if your taxable income is already near the OAS clawback threshold of $90,997. By using your TFSA for additional income, you avoid pushing your taxable income higher, allowing you to stay under the threshold and preserve your full OAS benefits. Without this strategy, if you had to withdraw the same $20,000 from a taxable account like an RSP, your income could exceed the threshold, triggering the clawback and reducing your OAS payments. The key word with your TFSA is flexibility. The TFSA gives you flexibility to access tax-free income and protect your OAS benefits, making it an essential tool for retirees looking to optimize their finances. Here's a pro tip, using the RRSP to TFSA ladder. Consider gradually withdrawing from your RRSP and contributing it to your TFSA before the age of 71. This keeps your taxable income lower later on and lets you withdraw tax-free from your TFSA in retirement, minimizing the clawback effect on your OAS. Next up is pension income splitting, but before we continue, make sure you hit that like and subscribe button if you're liking these tips so far. Alright, pension income splitting. Pension income splitting can be a great way to reduce your taxable income and avoid the OAS clawback, especially if one spouse earns significantly less than the other. This strategy allows you to transfer up to 50% of your eligible pension income to your lower income spouse, helping you keep your taxable income under the OAS clawback threshold. Let's take Peter Parker and his wife Mary Jane as an example. Peter earns $60,000 annually from his pension, while Mary Jane earns a much lower amount. By using pension income splitting, Peter can transfer $30,000 of his pension income to Mary Jane. This reduces Peter's taxable income from $60,000 to $30,000, putting him in a lower tax bracket and reducing the risk of triggering the OAS clawback. Meanwhile, Mary Jane, who's in a lower tax bracket, is now taxed on the $30,000 she receives, which means they pay less tax as a couple overall. And very importantly, by reducing Peter's taxable income, they can keep his total income below the OAS clawback threshold of $90,997, preserving his full OAS benefits. This strategy is especially useful for couples like Peter and Mary Jane, where one spouse earns significantly more than the other. Not only does it lower their overall tax burden, but it also helps protect Peter's OAS payments from being reduced by the clawback, making it a very valuable strategy for retirement planning. The next strategy is to manage your RRIF withdrawals. When you turn 71, your RSP converts into a RRIF, and you must start making minimum annual withdrawals, which are considered taxable income. These withdrawals can push your income over the OAS clawback threshold if not managed carefully. However, there are some clever ways to minimize this impact, such as using your younger spouse's age to reduce the withdrawal rate or tapping into non-taxable accounts like a TFSA first, which I mentioned earlier. Now, going back to Peter and Mary Jane, who have now aged a bit, Peter's now 71 and his wife, Mary Jane, is now 65. They can use her younger age to reduce the required RRIF withdrawal rate. Normally at age 71, Peter would need to withdraw 5.28% from his RRIF. But by basing the withdrawal on Mary's age, the rate drops to 4%. For a $200,000 RRIF, this means withdrawing $8,000 instead of $10,560, lowering their taxable income by $2,560. This reduction helps them stay below the OAS clawback threshold, preserving more of their benefits. I go into this strategy in more detail in my RRSP withdrawal strategy video, so check that out. I'll link to it in the description. The sixth strategy is to invest strategically in non-registered accounts. The type of income you earn from non-registered accounts can significantly increase your taxable income and potentially trigger the OAS clawback. Interest income from bonds or GICs or savings accounts is fully taxable at your marginal rate, while dividend income is taxed at a lower rate, but still adds to your taxable income. Capital gains, on the other hand, are only taxed at 50% of your marginal tax rate if you could stay under the $250K threshold, making them a more tax-efficient option. By focusing on certain growth investments, say things like stocks, which can primarily generate capital gains instead of interest or dividends, you can reduce your taxable income and stay below the OAS clawback threshold. For an example, if your portfolio generates $10,000 in interest income, the full amount is taxed, potentially pushing you over the OAS clawback threshold. But if you shift to growth investments, for example, say you invest in growth stocks that don't produce any dividends, that have mostly capital gains only half your gains will be taxed. So instead of $10,000, only $5,000 is taxable and counts towards your income. My main point is to be mindful of what counts towards your income when you're investing, so you could be more aware of what might push you past that OAS clawback threshold. The next strategy is to capture capital gains before age 65. Timing is key when managing capital gains to avoiding the OAS clawback. By capturing gains before you turn 65, you can avoid large taxable events once OAS kicks in. Capital gains occur when you sell assets like stocks or property for a profit, and while they are taxed more favorably than other income, large gains can still push you over the clawback threshold in retirement. A smart approach is to potentially realize these gains between the ages of 60 and 64 before you start receiving OAS. This allows you to pay taxes earlier and avoid increasing your taxable income during retirement. Here's an example. If you plan to sell a property or investments for a $50,000 gain, doing so at age 63 or 64 ensures that this gain won't count towards your taxable income during the crucial years when OAS begins, keeping you under the clawback threshold and saving you thousands in reduced benefits and taxes. Comprehensive retirement planning. Now tying it all together. When it comes to retirement planning, it's important to be aware of how strategies like delaying CPP and OAS, using your TFSA, and managing RRIF withdrawals can help you avoid the OAS clawback and keep more of your benefits. These smart moves can save you tens or even hundreds of thousands of dollars in retirement. It can be a lot of work to tie all this stuff together though, especially if you have a very complex case, such as if you have retirement properties or if you have a business. And that's what we help many clients with here at Blueprint. We work very closely with our clients to figure out all of these tough questions and potentially save them all this money in retirement. If you found this information helpful, don't forget to like and subscribe for more tips and check out our next video here.